Let's get your questions answered. Welcome to the Rookie Podcast, where every week, 3 times a week, we bring you the inspiration, motivation, and stories you need to kickstart your investing journey. I'm Ashley Kerr, and usually Tony Robinson is here, but we are joined by Noah Bacon. You might recognize him from being on the Rookie Podcast before and from his YouTube series, How I Started, aired on the BiggerPockets Real Estate Rookie YouTube channel. Today, we are diving into the BiggerPockets forums to get your questions answered. The forums are honestly the best place for you to quickly get all your real estate investing questions answered by many experts. So today, we're going to discuss whether you should chase cash flow or equity for rookie investors, how to determine how much capital you need to get started, and ways to transition out of your first house hack. So Noah, welcome to the Rookie Podcast as my co-host today.
Thank you, Ashley. It's always an honor to be here. Really excited to pick your brain a little bit, pick some rookie questions off the forums, and learn from the best with you.
I'm actually excited about a little debate here because this first question out here, I think we might have different answers on it, and we can get into a little heated discussion here, Noah.
I'm looking forward to it. I love the age-old debate here of equity versus cash flow, and I'd love to hear where your stance is because I'm sure mine's going to be a little bit different.
Okay, well, Noah, do you want to read off the question that was brought to us from the BiggerPockets forums?
Yeah, absolutely, Ashley. So let me read the first question here directly from the forums that I found. So, cash flow investing is for rookie investors. Sorry, I know this one's going to be painful for many rookie investors just getting started who want to live on the beach with their mail order cash, but this is not the way investing works. The real wealth is in equity. Equity and debt paydown are king. I've been investing for 15 years. I own over 60 units, manage 700, and have data and analytics on everything. The data is clear. Stable, B-class investing of quality assets professionally managed makes investors rich through equity. Play the long game, buy good properties with low cash returns and stable tenancy. Do you agree or do you disagree with this? And Ashley, I'll start with you. Do you disagree or do you agree that equity is king instead of cash flow?
I think this is a great long-term play. I want to kind of set the stakes here on this as to, are we going to assume that this is for a new person getting started? Because I think it's hard to actually debate and say like cash flow is king or, equity is king based off of, is this going to be something you start today and do forever? Or is this something you're just starting now and then it gives you the option to pivot? So if you're open to it, I would like to debate it as to like starting out, what should happen. But what are your thoughts?
I love that stance too. And that's exactly how I would love to set the scene. So let's say somebody is a rookie investor looking to get their first property, and their intention is to have this property for 10 plus years, not just have it for 1 to 2 years, look for a flip and start to move their pieces around. So let's have that long-term aspect for somebody that's just getting started out for their first property.
Okay, so my choice for a rookie investor starting out is to go for cash flow. Then as you build your foundation and get stabilized, then that will provide you the opportunity to go for equity. So that would be a kind of my basis is I am team cash flow. You guys can make the shirts. I will wear one that says Ashley's team cash flow.
And I'm going to be on the other side of it. So I guess you can make me a pair of shorts that says team equity or have on the back of my shirt team equity. But I take the stance on the other side where I do think having cash flow is extremely important. I'm not discounting that by any means. I look at it a little bit differently as if you have the rental income coming in and you're break even, maybe even a little bit negative, and you have enough to keep the lights on and you've done your due diligence up front, the equity to me is going to give you so much more of a return down the road, like we said, a 10-year investment than you're ever going to have with, let's say you're going for $200, $300 of cash flow per month and it's not going to appreciate the way that you're anticipating.
The first thing that made me be on team cash flow was the fact that a rookie investor is not experienced, that there's going to be mistakes made when analyzing a deal, when underwriting a deal, when doing the due diligence. I want that cash flow there to cover any of those unexpected costs that didn't come up. So maybe you are buying the property cash flowing, but then you underwrote it wrong and now you are breaking even. So that's my number one thing, that I want cash flow for a rookie investor, because you're not experienced. You may not know everything there is to know about analyzing a deal and you may make a mistake. And that cash flow will give you the room and the opportunity to actually eat that and it not be a devastating decision because you already bought the property at breaking even.
Yeah, that's a really good point. And I think you hit the nail on the head for a lot of people's fears initially out the gate is that I'm not going to be able to keep the lights on monthly if my expenses do overtake my income. I'm maybe going with the assumption here that they have a bit of a reserve already in place to say, if my tenant doesn't pay this month, I'm not going to go underwater immediately. And I do think, with let's say a property that appreciates at a 5% rate compared to a property that appreciates at a 3% rate, I think the situation here, investing in a B class asset compared to a D class asset where you get more of that cash flow, yeah, you are getting a better return on the monthly, but are you having more risk with that cash flow? And that's what I really like to look at in this situation. I myself invest in B to A class properties that are relatively break even, and I haven't had many tenant concerns. When I look at a C or a D class, sure, it could bring me in an extra $300, $400, maybe even $500 extra a month. That's a great amount year over year if my tenants are paying on time, if there's no maintenance concerns, if there's no property upkeep. And I just assume in these, higher cash flow areas that it's going to come with a premium on that side where you're going to inevitably have more problems than in a B class with a potentially safer bet to mitigate your risk a little bit. So I think the asset class has to really be in consideration here when we're talking about cash flow versus equity as well.
Yeah, I 100% agree with that as to there's that spectrum and you need to find like kind of that happy medium where it's not going to be a D or low C class property, but a B class property where you're getting some cash flow. When we talk about cash flow, that doesn't mean that I'm buying this one property and I'm quitting a W-2 job because it's so much cash flow. It's minimal cash flow. And I kind of mirrored this model after my own story as I started out with just buying properties that had $100 to $200 cash flow. It was zero money into the deal. I had reserves set aside with my business partner. And so with that, we had that little bit of security of cash flow where we didn't need to ever put money into the deal because something came up. And it was just that cushion. But then 5 years down the road, we sold that property. We had mortgage pay down that was from the tenants. We didn't pay that down. And then we had built up some equity. Not a ton amount had changed because of, the market conditions were great. So that really helped us. But even if it wouldn't have changed that much, there still was some equity. There's still going to be a little bit of appreciation every year, as long as you're taking care of the property. So then that's where you can kind of use the stack method. As you're buying these little cash flowing properties now, you go ahead and you can 1031 exchange into something different. And then that's maybe when you go into a property that has more, that's more equity based than actual cash flow based.
Absolutely. And I think like what we talked about setting the scene here with this being a first time investor, I think your approach definitely changes as you have skin in the game. When I was looking at my first property, I probably got stuck closer to this analysis paralysis that we like to talk about, where it took me 6 to 8 months to really find that deal where it hit my cash flow numbers. Second time around, rates are rising. Let's get in and get the equity because like I've heard very commonly in the past is you make your money when you buy. And, if you have a rate at a lower percentage, you're getting the equity right off the bat. My approach definitely changed from property 1 to 2 as you can, see you need to get in there to get skin in the game and actually, start to pay down your loan and actually gain the equity. I didn't want to wait anymore. Did your approach change as you've gotten, from rookie to more experienced investor, Ashley, where I have this analysis paralysis, I need a property that cash flows $500 a month? Are you still looking at that the same, or are you looking at it differently where my equity position is what really matters now down the road?
Well, I actually do have something that could go towards your side of the argument as well as like if you were in that predicament, maybe you owned a business and something happened with that business where you've lost all your income or you lost your W-2 job. If you have that rental property and you've been banking on equity and you've held it for a year, 2 years, and it does have that equity, you have the option to sell. So you could sell it, you could get rid of that debt, and then you have equity. And if you are going to buy a cash flowing property, you most likely are going to have less equity in the property because you have more debt on it because you want, as little of your own capital into the property. And so you're not going to be able to pull out as much of it because you're most likely, have too much leverage in the property because you really wanted to maximize what your cash on cash return is, but also cash flowing on the property. So I would say it's kind of like a double-edged sword. Like you do have options either way. And that's why no matter what, you should invest in real estate.
You can have your cake and eat it too, is what you're saying. Down the line, we eventually turn that equity into cash flowing properties. So I think we're speaking the same language right here anyway.
Yeah. And I think that's a great strategy to pivot. I think as rookie investors analyzing deals, look for that little bit of cash flow instead of saying, you know what, I don't mind putting $100, $200 into the property or breaking even, because you just don't know. And it just gives you that extra little sense of security. And there are deals out there where you can find that extra little bit of cash flow for sure out there, even with putting no money into the deal. Then if you are you don't care that much about cash on cash return and you want to put a lot of capital in upfront, but your mortgage payment is a lot lower and you have less risk that way, then you are going to get more cash flow because you're getting more of your money back that you actually put into the property too. So that's kind of a way to stay a little adverse, not to over leverage yourself and still have that cash flow coming in, but just make sure you're also calculating the cash on cash return. And it's not like you're just getting 1% cash on cash return back after you just dumped $100,000 into a property.
Absolutely. And this goes without saying to rookie investors, but don't anticipate that your first couple of properties are going to replace your W-2 income. Have the mindset that this is going to take 30 years until your loan is paid off. That cash flow can be great to help you out in immediate concerns. Like Ashley said, if something goes wonky in your career and now you're stuck without a job, it's great to have that cash flow supplement your life for the short term. Do not have that be your long-term outlook until you've reached a position where I can comfortably walk away and have this portfolio supplement my life. So I'm sure that goes without saying, but just a rookie warning sign of somebody who thought they were going to be a millionaire after owning properties for 24 months.
Yeah. And I mean, there are definitely people who do it, but we don't hear down the road, how it's going. But I think that's a great disclaimer as to you should look at this as whatever cash flow you make on this as bonus money and investment. So for example, if you have a 401k at work and you make returns on that money, you're not saying, hey, I'm pulling that money out. Woo, I'm going to, spend it. That's just reinvested back into your 401k. And that really is the best way. And then before you know it, it really starts to build up. But I completely agree. If you go in with wanting to completely quit your job, it is going to get frustrating. And there is nothing better than having multiple income streams coming in. So if you have your rental property income, maybe you property manage those. You have partners and you charge a property management fee. Maybe you make YouTube videos and you get a YouTube income coming in. All these different, you have your W-2 income. Maybe you got a landscaping company. There is nothing that's going to build wealth faster than having multiple income streams, because when one business is hurting or one income stream is hurting, you have the other ones to support that. And that is going to be such a better tool for building wealth than just relying on one income stream of rental properties. But another disclaimer, make sure you build that foundation first. Then you go and you kind of pivot off. Don't try and build out all these things at once. It'll be overwhelming and you just won't do a good job at each of them because you're trying to do too many at once. Start with one.
Spoken like a true queen of finances, where asset allocation and diversifying your assets is only going to benefit you down the road. I think, like you said, Ashley, this is a really amazing conversation to have for a rookie investor, because you want to think from the exit position. Where do I want to get to and how do I get there, working back from, let's say, 10 years to year 9, 8, 7, 6, and to today. What am I going to do to take action? And what strategy am I going to take to get there?
Noah, we have to take a quick break here, but I just want to say I'm really impressed with ourselves. We debated more like the vice president debate than the actual presidents that debated, if you're comparing the two. So we're going to take a quick break. And when we come back, we're going to go into some more rookie reply questions, such as how much capital did we each have to invest in our first property?
Welcome back. Well, Ashley, I think we have another cool question here that we found from the forums about how much capital you need to get your first investment.
Yeah, so this one we pulled, it says, What would you say is the starting capital needed to sustainably invest in real estate? I feel like that's the first thing I need to know in my planning. What was your experience with this? Is it wise to use loans to start? Please let this newbie know as much as you think is important. Okay, so let's start off with, I think the first thing, let's answer how much capital we each had to start investing in real estate and then tell why that was a good idea or a bad idea.
Yeah. So for my first property, I put 10% down. This was a property that I closed at 260,000. So I want to say cash to close, including the down payment of 26,000. I want to say it was all in around $35,000. That's how much I put just to the table to closing. With my reserves and everything else saved up, I had about $50,000 before I really started to consider investing into real estate. So I know 10% is higher than what some people look at for a 3.5%, 5%, or if you're VA, 0% down to really leverage. But I went a little bit more conservatively. I still pay private mortgage insurance, which, takes a little bit of your return away. But, 10% at a $260,000 property, I think for me to feel safe was that $50,000 amount to have reserves up front. But Ashley, what about you? How much did you have saved for your first property?
Probably like $5,000, which is not a good idea. I had very little money. I had just gotten married. I was expecting a baby, and basically all our money had gone to personal expenses in life, and there wasn't a lot of savings left. And so I partnered with somebody who had about $80,000 in his savings account. And that's what we actually used to make the cash purchase of the property. And then the money that I had saved was used for some of the repairs. Like we put a split unit in and replaced the electrical panel and then a couple other things like that. But it was definitely not the best to do that, I would say, is starting out that small. But that was something I knew going in, was that I needed a partner for that security, because I did not have the financial security to go in and purchase a property and know that I could cover the expenses for it every month, or if there was a big expense that came up or a tenant stopped paying rent and I had to cover the mortgage.
That's amazing to hear that from day one, that you were able to basically say, not I can't do this. It's how can I do this with what I have right now? And I think that's what a lot of rookie investors are asking with today's prices, with today's interest rates, is how can I actually do it? Another part of this question that was interesting to me was, is it smart to use loans? And I think this is just hearing from your story and my story, we're going to have a little bit difference here. It sounds like, and correct me if I'm wrong, but you guys purchased your property as partners with no loan. Is that correct?
Yes. And I will tell you that was because we didn't know any better. We did not know you could go to the bank and get a loan. We thought you had to buy in cash since we weren't living there and it wasn't a primary. So we just didn't know any better.
Then we may have the same opinion. We may not have any debate here, but I am all in favor of leveraging your money as far as it goes with loans. And I say as far as it goes, meaning you have that safety reserve. Your numbers make sense that you're either going to break even, maybe cash flow a little bit negatively, like we talked about how, if you have a great equity position, it could make sense, or you're going to cash flow and, have your cake and eat it too. I think with this unique scenario that you have to put a 3.5%, 5% on multifamilies now, it can really benefit you massively, but it can also really put you in a negative spot right out the gate. So I don't want people to get confused when I'm saying leverage as far as you can. Leverage as far as you can in a very smart and very risk adverse way. And that's what I did at 10%. It sounds like, Ashley, you would agree that's something you would have done probably for your first property. Try to leverage as far as possible. And that's what I would give advice to a rookie here. But you need to really make sure you're not putting yourself underwater and basically paying a mortgage just to have a rental property.
Yeah. And we actually did make a mortgage note payable to my partner. So our LLC for that property did pay him every month. So it was like we had a mortgage anyways. But yes, we would have rather have used his capital that he had for several down payments on properties. And when we went to go buy our third, we actually did go and refinance the first two to go and buy our third property. And that's where we really were started to get some more momentum. Is like, okay, great. We don't have to actually save all this cash, that we can go ahead and use debt to purchase the properties. But no, I wanted to ask you something about your PMI. So for anyone that doesn't know, if you put down less than 20% down, you are going to get charged private mortgage insurance by the bank. And this just gives the bank some security that you're not going to default, and, just in case there's not really any equity for them to go and sell the property on your behalf. They have this insurance in place. Noah, what was the dollar amount of that per month? And how long do you think until you'll be able to get rid of it? From like the day you purchased it, how long until you can get rid of it?
Great questions. And this is something I'm sure a lot of rookies probably have in the back of their mind when they are talking to their lender, or, just even considering putting less than 20% down. The PMI, typically what I hear is going to be 0.5% of the loan value is what you're going to pay on a monthly. For my situation, I put 10% down, like I said. I'm only paying $98 a month in PMI, so I actually am paying about $100 a month. So to me, $1,200 a year isn't the biggest deal. It is a tax deductible payment as well, so I always do kind of look at that with a grain of salt, that this is, as much as mortgage insurance is not the most fun thing to pay, it is something you potentially get money back for at the end of the year. So it's not the end of the world. Another question that you asked, Ashley, was when do I expect to have this PMI drop off? I think you said earlier in our conversation that if you put 20% down, you don't have to worry about PMI. That's exactly the target that I'm looking to hit. I actually think it's a little bit higher in my mortgage. You have to get to 22 or 24%. So they actually made it a little bit more strict to, incentivize incentivize me, the borrower, to be paying my mortgage on time and paying a little addition on top of it. But if I currently right now got an appraisal today, if I got a BPO, a broker's price opinion, sent somebody out there today, I guarantee you that I would meet that threshold of 22% loan to value ratio right now, or 78% loan to value ratio. And I'm sure today I could drop the PMI if I want to. Now I've kind of dragged my feet on it. There's a bit of a cost analysis to doing an appraisal that's about $1,000. So I would get that money back, I'm sure, immediately. It's just I need to take action and actually get this thing off of my loan. But it's not a huge, scary number, at least in the market that I was in first starting out. Could vary on your lender, of course, but I wouldn't let that number completely deter you away from investing until you've actually heard what that number is.
Yeah. And that right there just shows that, like, down the road, there is that potential for that added income, along with increasing rents too over time, that your mortgage payment will actually decrease by $100 a month, but you could have increased rental prices by then too. So there are added expenses and closing costs, all this stuff that comes with obtaining debt and leverage, but it's not always a negative thing, because you could either make $0 not doing anything, or you could make some money, and it's not the most perfect deal, but at least you're getting, something. You're getting started, you're taking action, you have that investment. So I don't want leverage to scare anyone, or debt, because it definitely is a way. And even though the interest rate looks awful, you don't want to pay it. If that means you can make the deal work, even if it's not the golden goose deal you could have got in 2021 with a 1.99% interest rate, that it's still a deal. It's still a deal. Don't get caught up in spending your time, spending your money on the most perfect deal. It may come, but it may not come. So make sure that you're not wasting your time trying to maximize your value. We see all the times the questions like, I have $50,000 in capital. Should I use it as a down payment? Should I purchase a house and a property with a partner? What is my best use of this $50,000? You can write out the numbers for each one, but you might get stuck in analysis paralysis, and you just need to take action on one. Having options is so much better than somebody who only has one path to take. So once again, don't get too caught up.
And I think just think about it from the lender's shoes as well. Like if Ashley or Noah comes to the bank and says, I want to borrow 95% loan to value ratio, That sounds extremely risky to them, I'm sure. They're going to put up 95% of a loan to say, hey, Noah, hey, Ashley, I trust what you're about to do. You're only bringing 5% in. So it's almost like, yeah, you're handcuffed for 30 years, but somebody's willing to give you, let's say, $400,000 to go buy a property that, you don't have $400,000 laying around. So to me, what's the PMI? If, like you said, you get cash flow down the road, it improves your position. And during that time, you're actually increasing your equity position. So it is that conversation again. Can I have my cake and can I eat it too with cash flow and equity?
So the last kind of piece of this question is, how much do you suggest that she would actually need to get started? She wants to start planning. What is the starting capital she should have before she even starts to make offers on property?
Yeah, so it's going to be really dependent on what your closing price is, of course. I think with my example, it still could be really risky in people's eyes that 10% down, still having, well, let's say you look at your reserves as basically your rental income. The property I was closing on was $2,000 a month of rent. I had $15,000 of reserves still. Very, very conservative to have over a year of reserves. But in my 2.5 years of investing, I've had $6,000 expense on a furnace. I've had a $9,000 bill on an eviction this year. That money's already gone just off two really massive expenses right out the gate. So I would say, probably 3 years ago, I would never be saying this and say, 3 months of reserves is going to be appropriate for you. In my opinion, save up a whole year, save up 6 months of reserves to really give yourself that safety net, because as a rookie, you're going to make mistakes. You're going to have these problems come up that you're inevitably going to pay a bigger premium than what you're going to pay 10 years down the line because you didn't have the right resource or the right contractor or, the right idea of how to go about a project. So I think that the number is going to be really dependent on your purchase price, but have at least 6 months of reserves on top of your mortgage payments that's going to cover you for at least 6 months.
Yeah, I think looking at your market is a great starting point. And what's the range of costs? So if you're looking at duplexes in Buffalo, New York, maybe you're looking in between $250,000 to $300,000. Okay. And you want to put 10% down. Okay. What's 10% of that? You're going to at least need that. Then you're going to have closing costs. So, what's common for closing costs? And you can actually go to a loan officer and you can tell them, like, I want to buy a $300,000 property, and they will give you a loan disclosure, an estimate that will tell you, like, here's what we estimate the fees to be and what the cash will be to close on a property for that amount in this market. And that will kind of give you, okay, I know I need at least this amount. Then you're going to go into the reserves. Okay. I highly agree with Noah doing 6 to 12 months, at least 6 months. And I look at as to if you are getting a little bit of cash flow, leaving that cash flow and just building up your account so that maybe you don't even have to tap into your reserves, that if there's an expense that comes up, you can tap into your cash flow and just leave your reserves sitting in, a 4.5% savings account and making you some money that way. And I say that with a grain of salt because I just got the notice that my account was decreasing from 5% to 4.5% now with the recent Fed decrease. So one time everybody's all happy that they're decreasing interest rates, but now my savings account rate has gone down. We're going to take a quick break. Okay, welcome back.
We love talking about real estate. We love answering questions like this with all of you. And we'd love if you could hit the follow button on the podcast app or wherever you are listening. So in our next question, we're going to discuss how to transition from your first house hack into your next property.
Okay, so for this question right here, it says, I have been a huge fan of the BiggerPockets podcast for years now, but I am just now creating an account on this site. Well, welcome to being a member of the BiggerPockets community. I am currently house hacking my townhome in Silver Springs and have been doing this so far for just short of several years. I'm looking to move as early as November of this year to get a second property closer to DC. I live in a townhome with 5 bedrooms and am currently renting out 4 of the rooms. So he's house hacking. And I live in the master suite. It is worth noting that 2 of those bedrooms are in the basement, which have their own entrance and an independent unit. To date, I have been self-managing my property and has been pretty straightforward since I was living there. However, with me moving out, I will not be there all the time, and this has made me wonder how I can manage this property with 5 tenants. I would like to continue to self-manage this property, but I am open to a management company. As of now, I'm looking for any advice on what I should be doing to prepare for this transition and how people have successfully managed room sharing properties. Any advice would be appreciated. Honestly, I think it would be easier not living in the apartment because you really have to try to keep the peace you're, living with these people. So, Noah, what do you think about this? Have you done this with your strategy? Is rent by the room?
Yeah. So when I lived in my properties, they were rent by room. They were in HOA communities. And when I moved out, they had to be full-time leases. So I was in a kind of unique situation here where I have this strategy. Now I need to kind of transition out of this strategy, keep it into my next property. But while I move out of property one, kind of switch around what I was doing with the leasing. So it sounds like for this property, there's 2 ways that I would go about this. And you can do full-time property manager. I don't know how far he's moving away from the property, but I do like to have just starting with the easiest first. And to me, that would be converting the property he's moving out of into a duplex and using a full-time property manager. He says here that he has a separate entrance to the basement, so you can split it into 2 units, basically, have a full-time property manager, manage those as traditional long-term leases in separate units. So not everybody that's in the property is on their own lease, can have all this crazy occupancy and turnover during the year. And you have that stability when you move out, because moving from one property to the next, what you're looking for is stability. You don't want to go into property number 2 completely over leveraged and mismanaging property number A. So for me, look for property manager and split it into a duplex. Or if you want to do the rent by the room situation, have you made a relationship with any of the tenants that's more substantial than the others? This is something I can speak on from my experience where I was moving out. One of the tenants that I was living with in my house hack, we had a really, really great relationship. I actually decreased his rent, put all 3 tenants on one lease. He was responsible for a little bit less, as he was basically referring new tenants coming into the property as I was moving out. I like to call him my tenant property manager because he saved me a crap load of money. He saved me a lot of headache during my time as I was moving into the next property. And I was focusing on leasing the next property I was moving into. To have him basically have no days of vacancy for me and just decrease the rental rate just ever so slightly to keep him satisfied, it was a home run, like really a home run right off the bat. So like I said, didn't have any days of vacancy. I didn't have to really worry about, anything really going wrong for the next couple months as I had 2 really solidified leases in my properties. So, that's a really unique example, I'm sure. But if he had any great relationships with the tenants there, can you keep them satisfied with a very slight rental decrease while moving in more people to increase your bottom line, basically?
That's a great point. I did that with a resident to mow the lawn. We decreased his rental rate a little bit, and it would have cost probably 4 times to have somebody actually come and mow the property. It was a triplex than if we had him do it. And sometimes those resources are great. You do want to be very careful though, and make sure that there's an addendum to the lease or something that states what their specific duties are and that the rent will be increased back to the normal rate if those duties aren't fulfilled or something like that, to kind of protect yourself and to protect them. So when you did this with that property manager or that tenant in place to kind of act as your tenant manager, what were some of the things you didn't have them do? Were they collecting rent or anything like that?
No, they weren't collecting rent. I was self-managing the property from afar. What I really relied on them heavy was for referrals for the application process. So basically, I did everything as the property manager when it came to tenant screening, when it came to any tenant disputes, maintenance concerns, things like that. But to give you a little bit more of the situation, he was a manager at Amazon, actually referred me to 2 more managers at Amazon that were, just looking for another place to live. Get them all on one lease, decrease his rent because of basically a finder's fee. And he was extremely responsive due to our relationship whenever dishwasher concern, fridge concern, anything with a neighbor that would potentially come up. Hey, they missed trash this week. I'm very happy to get that text from somebody that I can call a friend instead of a tenant that I don't know. And I do get mixing business with friendship can be a little bit froggy here and there, but the relationship we had was very transactional and was I'm gonna scratch your back a little bit if you can scratch mine and help me find some tenants to move in. So it was a really cohesive relationship that we had throughout our house hacking tenancy, and then as I was turning into his full-time property manager.
Noah, what I'm getting from this is that somebody who's in this situation needs to look and figure out, okay, here's the reasons or here's the things I need somebody to do in order for me not to hire a third-party property management company. Here's why I'm having reservations of self-managing. And for you, it was, finding the tenants and maybe showing the apartments, things like that, because you couldn't be there because you're trying to get into your other place. And you found somebody that could do that. And even though it seems like such a small role of all of the property management duties, you had systems set up there, the amazing software that's out there to manage rentals, that you could handle it all. It was just those two little things that you needed someone like the boots on the ground. So I think that would be my suggestion, is think about what are the hesitations or the reservations you have when renting out room by the room, when you're leaving the property. Why do you think it would be difficult for you to manage from afar? And then that's maybe where you're finding, okay, I need to hire this person to do this specific role. And it doesn't even have to be a tenant. Like maybe you just need a handyman that can go over there and run over there if there is some kind of issue that needs to be taken care of. Then, maybe it's not a service call for a full-on plumber to come, different things like that. So yeah, I think that's a great idea, Noah. Okay, well, thank you guys so much for joining us on this week's Rookie Reply. And Noah, thanks for being such an awesome co-host and providing new and insightful information to our rookie listeners.
Thank you for having me, Ashley. It's always an honor to be here with you.
If you have a question and you want to find out some more information about being a rookie real estate investor, head on over to biggerpockets.com/forums. And if you haven't already, make sure you join BP and sign up as a member. Okay, well, thank you so much for listening, and we'll see you guys next time. I'm Ashley and he's Noah. We'll see you on the next Rookie Podcast.